Hi, this is Tony Sagami. I want to talk to you about technology this week, in particular about Google. If you're a Google investor or own an ETF, a mutual fund that has a lot of Google in it, you should pay attention. And the reason I say that is because you have to wonder, with the new developments that are going on in China, whether or not Google has seen its best growth days behind it. In case you hadn't heard, Google is facing the very real possibility that the Chinese government may block them from doing any business in China whatsoever. They can't do that. Well, yes, they can. China's a communist country, and they can do whatever the heck they want, and they especially don't care too much about what a U.S. company wants. Right now, the Chinese Ministry of Industry and Information, they're currently reviewing Google's renewal application, and they're not too happy with Google's recent decision to redirect all its Chinese Google users to a server in Hong Kong that's not currently censored, and that's in direct violation of Chinese law. Even if Google does keep its Chinese license, I believe that Google's not going to do very well in China at all. And that's bad news because Google is a company that, to justify its tremendous multiple, needs to continue that 30+% revenue and profit growth rate that's been able to deliver. And I don't think they will. China is really important to get that because they have 400 million users, internet users in China. That's a lot of bodies. And on top of that, that's only about a 30% penetration rate. So there's still a ton more growth up in China. So if Google does not capture that market, it's in some serious trouble. For example, but its market share just in the last 12 months has fallen from 35% to 30%. Meanwhile, their largest Chinese competitor, Baidu, .com, the ticker on that is BIDU, their market share has grown from 58 to 64%. So you can see they're dominating the Chinese internet portal business. Now, if you think that the internet search and portal business is an area you want exposure to, there's some other options besides just Google. Number one, the ones that I would urge you to take a look at would be Baidu, and that's BIDU. That's the largest one, but that's selling for 89 times earnings. Sohu.com, and the ticker on that is SOHU, is selling for 13 times earnings. And another competitor, Sina.com, SINA is the ticker, SINA, they're selling for only 4 times earnings. Sina is kind of the Yahoo of China, as Yahoo's the number 2 web portal in the U.S., and is way behind Google. It's still significant business. You can say the same thing about Sina.com. And listen to this. They've had a 48% annual compounded earning growth rate and a 46% return on equity. So if you want to invest in the Chinese internet business, Google is not the way to do it. And those other Chinese portals, Baidu, Sohu, or Sina, are the way to go. Until next week, this is Tony Sagami signing off.